Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of securities fraud in 2024. What investors should beware of. Understanding securities fraud. Common types, warning signs, and how to protect yourself. Securities fraud isn't just a problem for Wall Street. It can impact anyone investing their hard-earned money. From misleading financial statements to outright scams, this type of fraud undermines trust in financial markets and can cause devastating losses for investors. Knowing what securities fraud is, how it works, and how to spot warning signs is essential for safeguarding your investments. Let's break it down so you can stay informed and protected. What is securities fraud? Securities fraud is any deceptive practice in the financial markets that leads to unfair gains. It occurs when someone manipulates markets or misleads investors to steal money or distort investment decisions. This can involve stocks, bonds, commodities, or other investment securities. Securities fraud undermines trust, destabilizes markets, and can cause losses for everyday investors. Whether you're an experienced trader or a casual investor, understanding how this happens is critical. Types of securities fraud. Securities fraud comes in many forms, and each type has its own methods. Here are some of the most common examples. Insider trading. This happens when someone with access to non-public information about a company uses it to make trades. For example, if an executive at a corporation buys shares knowing big news is about to break, they're using an unfair advantage. Ponzi schemes. This is a scam where returns to earlier investors are paid using the funds from newer investors. The scheme collapses when no new money comes in. Victims are often lured by promises of high returns with little to no risk. Pump and dump schemes. Scammers artificially inflate a stock's price, the pump, by spreading false or exaggerated information. Once the price skyrockets, they sell off their shares, the dump, leaving unsuspecting investors with worthless stock. Accountant fraud. Dishonest accounting practices that hide the true financial health of a business. Companies might fake profits or hide losses to attract or maintain investor support. Misrepresentation or omission of facts. This involves withholding critical information or giving false details about investments. It could be something as blatant as lying about risk levels or withholding knowledge of a company's pending bankruptcy. These fraudulent acts vary in complexity, but they share one goal: to manipulate or deceive for financial gain. Legal framework surrounding securities fraud. Laws and regulations exist to ensure fairness in financial markets and to hold wrongdoers accountable. Here are 2 key pieces of legislation that address securities fraud. Securities Exchange Act of 1934. This act was created to oversee securities transactions and prevent fraud. It established the Securities and Exchange Commission, SEC, giving it the authority to regulate trading and punish those engaging in deceptive practices. This law requires public companies to disclose significant financial events to protect investors. Dodd-Frank Wall Street Reform and Consumer Protection Act, 2010. This act was introduced in the aftermath of the 2008 financial crisis. It heightened regulations on financial institutions and increased penalties for fraudulent activities. The Dodd-Frank Act also created whistleblower protection programs that incentivize reporting securities fraud. Sarbanes-Oxley Act, SOX. While not always directly cited, SOX imposes strict rules against corporate fraud and improves accuracy in financial disclosures. These laws act as both a shield and a sword. They aim to protect investors while targeting those who break the rules. The SEC and other federal agencies can fine, imprison, or ban individuals or companies found guilty of securities fraud. Understanding the legal framework gives investors confidence to act. It also holds bad actors accountable when their schemes damage lives and markets. Causes of securities fraud. Understanding the underlying causes of securities fraud offers valuable insight into how such deceptive practices can occur. A mix of factors can lead individuals and organizations to engage in fraudulent behavior, often with far-reaching consequences. 2 significant contributors stand out: opportunity and greed, along with a lack of regulation. Opportunity and greed. The potential for high profits often tempts individuals and companies to sacrifice ethical standards. Greed can cloud judgment, leading to decisions that prioritize short-term gains over long-term integrity. Consider how the lure of quick returns can create an environment ripe for fraud. Investors searching for ways to maximize their profits may become unwilling to question the validity of enticing offers. This negligence can lead to overlooking red flags. Here are a few ways opportunity and greed manifest in the financial sector. Unrealistic projections. Some companies exaggerate their growth forecasts to attract investors. When profits don't materialize, the fallout can be devastating. Pressure to perform. Employees may feel pressure to meet unrealistic targets. This can lead them to engage in unethical practices to achieve goals. Euphoria of the market. During market booms, participants may feel invincible. This can lead to reckless behavior, as the fear of loss is overshadowed by the thrill of gain. This environment fosters a culture where unethical behavior not only becomes normalized but is sometimes celebrated. When profits become the sole focus, ethical considerations often take a backseat. Lack of regulation. Insufficient oversight in the financial markets often allows fraud to thrive. When regulations are weak or poorly enforced, individuals may feel emboldened to engage in deceptive practices without fear of consequences. Take a moment to consider the impact of regulatory lapses. A lack of oversight can create a breeding ground for fraudulent activities. Here are several dimensions of how this manifests. Inadequate monitoring. When regulatory agencies lack the resources or authority to monitor the markets effectively, fraudulent activities can go unnoticed for extended periods. Complex financial products. The proliferation of complex investment vehicles can obscure risks. Many investors may not fully understand these products, making them vulnerable to scams. Desire for innovation. Some regulatory bodies prioritize innovation over strict oversight. This can lead to unregulated spaces where fraud can flourish. In this context, the absence of robust regulations can create asymmetric information, where dishonest actors exploit their knowledge for personal gain while leaving investors at a disadvantage. By examining these causes, investors can equip themselves with the awareness needed to recognize and avoid potential traps in the securities market. Impact of securities fraud. Securities fraud has significant implications that cut across various sectors of society. Its impact extends beyond direct financial losses, influencing investor morale and market stability. Understanding these consequences sheds light on why addressing securities fraud is crucial for maintaining trust in financial systems. Effects on investors. Investors face dire consequences when securities fraud occurs. The most immediate impact is financial loss. When fraudulent information distorts stock prices, unsuspecting investors can lose their savings almost overnight. They may have invested not just their money but also their trust in the market's integrity. Financial losses. Many victims find themselves with worthless shares or diminished portfolio values. The emotional toll can be just as heavy. Losing money often leads to anxiety and stress, impacting decision-making and risk tolerance in future investments. Erosion of trust. Beyond financial losses, there's a deep sense of betrayal. When fraud is exposed, many investors feel deceived. This loss of trust doesn't just affect individual relationships with specific companies, it can discourage wider participation in the market. Investors may start questioning the motives of all companies, leading to a more cautious approach. Long-term consequences. Some investors never fully recover. They may pull away from the stock market entirely, opting for more conservative, low-risk investments. This shift can stifle personal wealth growth and alter retirement plans. Have you ever thought about your financial strategy if trust in the market diminishes? Many are forced to rethink their investment approaches. Impact on financial markets. Securities fraud affects not just individuals but the broader financial markets. When fraud is prevalent, it creates an unstable environment. Market stability. Fraudulent activities can lead to significant market fluctuations. As news of fraud spreads, stock values can plummet. This creates a ripple effect, impacting even those investors who are not directly involved in the fraudulent activities. Investor confidence. A drop in confidence is one of the most dangerous impacts of fraud. When investors fear that fraud is rampant, they may choose to withdraw altogether. This can lead to reduced liquidity in the markets, making it harder for businesses to raise capital or operate effectively. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.